Hello, everyone. Welcome to our webinar series, Capital Market Development, China and Asia. And today we are very happy to have two great speakers to share with us their thoughts on stock market participation. Our first speaker is Pulak from India Institute of Management. He will present his paper, Road to Stock Market Participation. Pulak, the floor is yours. You have 25 minutes. I will let you know when you have 3 minutes left.
Thank you, Michael, for inviting me over. So basically in this paper, what we're trying to see is a new kind of instrument like roads or infrastructure. If that is helpful in stock market participation, bringing new investor, what happens to the old investor, and what kind of people are getting interested more. So that's the main focus of this paper. Now, in general, this has been a puzzle. It's almost in every country, the stock market participation is not up to the expectation level. And this is more so in the developing countries. And particularly, in developing countries, in general, people consume less, save more. And there is always a tussle between higher savings rate and risk-taking appetite that is there. But in general, as you see several papers before, this is not a developing country phenomena. It's pretty much all over the world. But this is an important issue. In India, Securities and Exchange Board of India, or what we call SEBI, is the main regulator for regulating the market as well as for bringing people in the market. This is important for several reasons. Definitely for capital market development, economic growth and reducing inequality, as well as democratization of finance. It's also at the household level, it gives a new kind of household income or household returns instruments. Especially this is important given that now all over the world, including India, the other instruments are coming down heavily. For example, savings rate, deposits rates are very low, inflation is very high, and so on and so forth. So this is an important, it has a policy implication for development and regulation. Excuse me. It's not new, but there have been several papers on trying to figure out, why there is low participation. And broadly, that can be divided in 4 different phenomena. One is maybe the transaction cost or fixed cost of participation. Then there's a bunch of paper on how financial literacy and household education can play a role in market participation. There is also social interaction and peer effects literature, which talks about this. And then there is some work on lack of stock market awareness might be a reason of low participation. The SEBI, which is the India regulator, did a survey in 2015, and they kind of figured out that majority of the people are actually inadequately informed about plus and minus of the capital market, how to get in there, what are the potential ways of participating. Also, people think about 15.54% of the people thought that there are inadequate returns compared to other instruments available in India, so why to bother? So this was a survey done very recently in 2015. Now, that brings us to the research questions we are trying to address here. So our main focus is physical infrastructure. By physical infrastructure, we need feeder roads. So feeder roads is basically a nationwide scheme where the metro cities are connected to the rural roads, community through feeder roads. So that has taken place from 2000 onwards. So what we are trying to understand is, does this infrastructure affect stock market participation in developing country or vis-a-vis in India? And is there heterogeneity across the investor types? So is there a certain kind of age group who take advantage of this more? Our female participation has increased because of this. And also what happens to the urban versus rural and richer versus poorer regions. Now, although this is a new angle in terms of stock market participation, the effectiveness of physical infrastructure like road in general is not new. But the consensus is not there. There has been some work which has shown that this kind of feeder roads are extremely useful for financial access, entrepreneurship, and so on and so forth. And there is some other work which shows that the benefit are not that strikingly high. So,
Pulak. Yeah. So we are still looking at the cover page.
Yeah. So I was in this slide. So as I said that there has been mixed responses of use implication of physical infrastructure, particularly this kind of road construction, on the financial access, entrepreneurship, as well as other development. But ours is the first one to look at the use of this kind of road construction in the financial in the market participation. And as a mechanism, we are trying to stress on two facts. One, that when roads come, more financial inclusion happens. So that's enabling channel through banks coming in for more business and so on and so forth. And the second is the information channel, because if road comes, people travel more, so they become more aware, they have more information, and so they may be willing to participate in the market more. So these are the two main mechanisms which we'll try to nail down the road. So in the financial inclusion channel, basically what we are trying to do is we looked at the bank branches as well as the number of new branches coming in a particular pin code. So pin code is equivalent to zip code in US, and a particular pin code post getting the road constructed or connected. And that definitely gives a greater savings potential. And so that's one angle. The second angle is that it can work both from the supply side as well as from the demand side. Demand side in the sense that in order to participate in the market, an individual investor has to get something called demat account by filling out a form through SEBI. Now, if these banks come, these banks can be an intermediary, and so this filling out form and all those becomes much easier, so the transaction cost goes down. At the same time, these bank managers can talk to this retail investor, and they can motivate these people also to come to the market. So in the financial inclusion channel, mainly it's the roads, so the greater access to the bank, and then that leads to the stock market participation. On the information channel, it's the usual story. So if the infrastructure improvement happen, then people start traveling, they can access banks much faster. They can go to other markets for, let's say, the businessman, agricultural farmer, they have more access, they can go to the cities, which basically what happens, you increase the connectivity, reduce the information cost, and obviously you talk more people, so you have more general awareness. So that's the information channel we are trying to look at. So what are our main findings? Number one is we find, as expected, a significant increase in the stock market participation associated with building new feeder roads to the level of 33.2% increase in new investors and 90.6% increase in trades by new investor. And that boils down to about 7 new investor per month and about 300 trades in a pin code year month, right? Now, we also found that the effect is maximum within the first year of road construction. And although the effect is there post 1 year, it stays about 5 years and then kind of comes down. On the heterogeneous side, heterogeneity analysis, we found that male investor and mature investor are taking maximum advantage. Now, this is more or less in consensus with the existing literature, which say that male investor and middle-aged group are, participate more. And another we divided the pin codes in rural, intermediate level of economic development, which are not like metro cities, but has some amount of development, and the poorest region. And we found that the maximum benefit is actually taken by the people living in the intermediate levels of economic development. And it also supports the information channel. So we show that the improved connectivity leads to stock market participation in more distant pin codes. So increased portfolio diversification, as well as increased trading in stocks of firms whose headquarters are farther away from the pin code you live in. Some of the other findings we have that it also supports the financial inclusion channel. So we find that the greater impact is when a new bank branch opened within the first 3 years of the road construction. And also, as we said before, it's not just the marginal investor. So investing after positive wealth shock, it's also in from intermediate level of economic development. The question is that if these guys are trading for the first time, where do they get the money from? So some of the points we have explored is whether there is a capital reallocation happening in the household. Are they saving more, or their income going up and they're saving less, and maybe that money is coming to the market. And we don't find that the new investors are taking a lot of risky steps and they think that getting to the stock market will make them rich overnight. So that kind of behavior we did not find in the new investor. So there has been lots of work on stock market participation, and I'll just go over this one more time. So one literature where our literature connects heavily is the literature of stock market participation puzzle. And our paper advances a new mechanism in this literature, which is the infrastructure improvement, whether that really affects the market participation. This also broadly relates to the literature on financial development and growth. So our paper has implications for how to facilitate the capital market deepening. There are mixed evidence on PMGSY program, which is basically the roads program we are talking about here. And there are some papers like AGARWAL and all, which shows that these are extremely useful in female entrepreneurship, in financial access and financial inclusion. There are other papers like Adukia, Asar and Novosad, who shows that the effect is not that strikingly great. So our paper is kind of focusing on the spillover of this to the investment. Let's come to the data side. So we put together some interesting data. The main data we have are from National Stock Exchange of India, which has about 86% market coverage. Now there are two exchanges in India. One is National Stock Exchange NSE, and other is Bombay Stock Exchange, which is the BSE. And BSE has about 14% of the market coverage. So the data we have is a comprehensive universal data from NSE, no random sampling, on the daily trading information across 1.3 million investors between 2004 and 2015. So this is the statewide distribution of investors. So obviously majority of the investors coming from industrial state like Maharashtra, Gujarat, but there are also other states like West Bengal, Uttar Pradesh, which are not so industrial state, but the market the number of investors are pretty high. For each investor, we also know some demographics. We know their gender, their age, and the location, which is the PIN code, which we'll be exploiting. Each trading data contains the date of the transaction, account type, script size traded, the number of shares purchased or sold, and the execution price. And for this study, we only concentrate on the domestic companies. So this is the main data which we'll be exploiting. Our identification comes from the PMGSY data, which is the Government of India's flagship program launched in 2000 with the aim of improved rural connectivity. The data has been cleaned and put together by SRAG in the SRAG platform. So we took the data from there. And for each new road built under the program, we have the exact completion date, village, and geocode location. So the lat long is there, which can be connected to the pin code. For our work, because our NEC data from 2004 to 2015, and by 2015, almost every rural sector got the road. So we restrict our sample to all pin codes that received a new PMGSY road between October 2004 to February 2015, and did not receive a new road prior to the 2004. So as I said, by 2015, all the pin codes receive a new road at some time point during this phase. We also, in order to look at the consumption and savings channel, we got the data on bank branch data, or called RBI BSR data. So what the RBI BSR data does is, for each bank branch, you got a bunch of variables every year, including savings, loan given, and a lot of other factors from each bank branch. And they also have the branch location and opening date of the branch offices, and several things on the savings and investment rates. So we'll use that also. So here is our first excuse me empirical specification. So we have our entire analysis is at the investor pin code year month level. So Y is the different measure of stock market participation in each pin code and year month T. So we consider two dependent variable. One is the number of trades, and there is the number of investor across different type of investor. So our main variable of interest is beta, which gives us the number of trades or number of investor post connecting through the road. We also have the location, month, and district year fixed effects to absorb the time invariant factors across location and month. And we have also added a state state year fixed effect. So the first set of results basically showed that once the road is connected, the number of trades and number of investor both are positive and statistically significant across all investor, and also if we divide it by new investor and experienced investor. Definitely the numbers are much higher for the new investor. So definitely new investors are coming in a much more than the experienced investor, increasing the number of trades, right? So we have like construction of new feeder road in the pin code leads to an average of 33.2% in number of new investor, and 90.6% increase in trades by new investor, which translates to about 7 new investor and 300 additional trades. And across demographic groups, we find that the road effects are most prominent among the male and the mature investor. The baseline results are robust to different settings. So we did a randomization of the entire sample. We didn't find anything. Randomization within each month, and we didn't find anything. And we also did the Callaway and this time varying DID specification to take care of the two-way fixed effect weights problem, and there also the results hold. So coming back to some dynamic trends, so these are the coefficient estimate over time. So we find that across both the dependent variable, the effect is positive and significant right after the road is built, and the effect is most prominent in the first 1 year. Although the effect is positive for next 5 years, but the effect comes down over time for both new investor and all investor across the number of trades as well as the number of investor. Now, local economic development. So if we take the interaction of connect by rural, then definitely the rural people are taking maximum advantage of this. Now, among the rural people, again, we have divided in two groups: intermediate developed areas in the rural and the least or poorest region of the rural. So what we found is that the majority of the advantage are taken by the intermediate development areas, the pin codes within the intermediate development, both in the number of trades as well as the number of new investors. Now let's come to the mechanism part. So in the financial inclusion channel, what we found, so we created a new branch dummy as an indicator variable, which takes 1 when the bank branch is opened within 3-year window after the PMGSY road completion in pin code and otherwise, and we also count the number of new branches. Now what we found is that if a new branch comes in that pin code, then the number of trade increased almost by 10%, and the number of investors also positively significant. Now, it is also positively significant the more new branches come in. So for every 1 new branch coming in that region, we get about 6% increase in the number of trades, right? Now, we divided the bank branch again in public versus private, and we found that the majority of the result are driven by the state-owned bank rather than the private banks, which also is kind of comforting because state-owned branch has least incentive to motivate people to come to the market. On the information channel, we explored first the distance to the nearest metropolitan city. So distance is between pin code and the nearest city, and we found that the pin codes which are more distant from from the cities, they are participating more. So they are positive and significant both in terms of number of trades and number of investors. They are also doing more portfolio diversification. So we looked at the number of unique tickers, and we found that once they are connected, then their portfolio has more different kind of stocks. And then to nail it down further, we divided the distance in 4 subgroups. So less than 50 kilometer, 50 to 100 kilometer, 100 to 500 kilometer, and greater than 500 kilometer. And what we found that the effect is not there for people in close proximity of the city, but effect is positive and significant across 50 kilometer onwards. And so that also, also verifies the information channel which we're trying to explore. Now, where does this money come from? So is it coming from reallocation of consumption? So there is this survey on CMI, Center for Monetary Control of India's Economy, and they do this survey from 2014 onwards, which called Consumer Pyramid Survey. And they have bunch of questions they asked all across, and this is done every month, although reported quarterly, but they do it every month. And we have used that because they started from 2014. We don't have data before, so we have used just 2 years of data. And what we see is that the pin codes which get connected through this feeder road, they actually reduce the consumption, and their income increases. So there is some, now once the income increases, we need to look at what happens to their savings then. So from the RBI BSR data, we actually have lots of variables, but out of that we took these 4 variables. One is the current account deposit, savings account deposit, term account deposit, and the total deposit in a bank branch. Now, every bank branch, we know the pin code, so we can connect to them, and then we can take that whether the road came in and when this bank branch came in. What we found is that people in the bank branches which got connected with the road, they are actually savings less, and the total deposit also going down. So we have these 2 things. From the CMA survey, we see that the regions which get connected to the roads, their consumption going down, their income going up, but they are not putting the money back in the savings account of the bank. So we interpret this as probably there is a reallocation of portfolio happening, and this money is going to the market.
Pulak, you have 2 or 3 minutes.
Okay, yeah. Now we are also trying to look at that whether these new investor particularly, are they taking too much risk in the market, like a gaming or something? So we looked at the average profits per investor month across different length, 1 trading day, 10 trading day, 25 trading day, and 140 trading days. And what we found is that up to 10 trading days, they are investing more in more profitable stocks. However, on a longer term, they're actually doing it in a less profitable stock. But also the number of trades on high volatility stock is high. So they're taking some amount of risk, but not a lot. But they're trading more on the profitable stocks. So with this coming to the conclusion, so what we have now is that we have shown that there is a novel mechanism on the physical infrastructure connecting the feeder road, which affects the stock market participation rates in developing countries. So improvement of physical infrastructure, at least for the market participation, is very, very important. We find support for 2 channels. One is financial inclusion channel, and there is a large impact of state bank branch openings, and then information channel. In addition, there is some suggestive evidence on reallocation of household portfolio, and not just marginal investor, also intermediate investor are taking benefit from this positive wealth shock. So the takeaway is that improving physical infrastructure addresses the twin problems of financial access and inadequate information, allowing for better integration of investor in remote and rural areas for which these roads are being connected. So I'll stop here.
Thanks a lot, Pulak, for
I will stop.
Yeah, for the good time control and wonderful presentation. Now let's welcome our second speaker, Harrison Hong from Columbia University. Harrison, you also have 25 minutes.
Yeah, thanks for the opportunity to discuss this interesting paper by Pulak and his co-authors. And it's my pleasure here to be part of this ABFER webinar series on capital market development in China and Asia. So let me kind of summarize the paper first. So what this paper does is that it studies the effect of this PMGSY national road construction project in India that started in 2000 and ended in 2014, and examines the consequences of this road construction project on, sort of stock market participation rates at various cities that are part of this construction project. And the reason it's interested in this this particular project, of course, is that there's nice random variation in when roads connecting to towns are finished. Okay, so you can use some of this staggered completion, right? These staggered completion dates as a way to draw some causal inferences. My understanding is that this design is pretty widely used in development economics, but I think now is beginning to sort of come vis-a-vis financial economics as well. So that, this paper is a nice development finance paper, and has a lot of nice features, and the authors there admirable job of connecting lots of interesting data sets to help our understanding of what drives stock market participation rates. Okay, and essentially the paper using this sort of diff and diff design establishes a reduced form causal effect of completion of these road connections of these towns or cities that were previously disconnected from kind of the major thoroughfare, establishes a causal effect of this road connection to higher stock market participation rates in that city. Okay, and it also provides additional evidence on 2 mechanisms of why these participation rates might be rising. This predominantly exploits some cross-sectional variation in terms of underlying demographics associated with these cities to establish these channels. So for instance, I'll talk about these more, but it kind of points to two channels associated with information or some notion of peer effects, and also this financial inclusion channel that is identified using bank branches. Okay, so that's the main summary. So my roadmap is let me first talk a little bit about what a simple model of household stock market participation rates in a given region. So this is a model that I had in a paper with Kubik and Stein a number of years ago, where we tried to understand these various factors in the context of the US. But I think that the simple model will help, I think, narrate what we think we can learn about the mechanisms. And then I'm going to reframe some of the analysis. I think a lot of the analysis in the papers is predominantly, I would call it kind of a reduced form, where you've got this diff and diff with these completion dates of roads on some left-hand side variables. Maybe you have some cross-sectional variation, basically looking at how these completion dates, affect different types of underlying cities differently. But what I would do is I reframe some of the analysis as a 2SLS, right? To clarify, I think, the limits of, I think, what we can learn from this design, and to also suggest, some deeper structural work for the paper. And then kind of my final comment would be that the paper, I think right now is positioned as a paper that's predominantly about understanding the stock market participation rate puzzles, about why it is that participation rates would appear to be so low, given what we view as all the benefits associated with this market. Although I have to say that it's not so clear to me there's a stock market participation rate, for instance, in China, for instance, right, where the returns of the market have been actually quite bad. So I would say that the paper could also be positioned from the perspective of a cost and benefit analysis associated with public goods spending, right? So that, there's a lot of work in development, and also really just in general urban infrastructure planning work that talks about costs and benefits of connecting roads. But I think oftentimes the cost and benefit analysis ignores like a financial sector, essentially, right? And so so this is sometimes what's called basically some other coincident benefits associated with public goods spending. I think the paper is probably pretty persuasive for me, that there are these coincident benefits that probably planners may not really take into account, and perhaps probably less persuasive in terms of, I think, without more work on kind of what I view as mechanisms behind the stock market participation puzzles. Okay, so let me just talk a little bit about the model of stock market participation rate to kind of frame some of the stuff that Pulak had already talked about. So our basic model of participation rates is like there's some net cost of participation, right? So there's going to be CI. Think about CI as some fixed cost that's being drawn in the population, right? So in a city, different people may draw different costs. Okay, so these costs are kind of special to the person because some people find it to be more of a hassle. Maybe they're more literate, et cetera, et cetera. And then there's maybe some common parameter theta that they kind of amplifies this cost in a given region. And then we also think that there's some benefits associated with these costs are affected by the fact that if there's a lot of people participating in the stock market, there's a lot of information sharing. There's some other benefits that come online, right? So that basically reduces these costs. And so using like kind of a static model where you have a CRRA household that participates when the certainty equivalent of wealth for participating exceeds the wealth from not participating, right? There's like a cutoff condition that determines whether somebody participates, right? So it's got to be that. So W, let's say, is the wealth. Alpha is going to be a parameter that captures, all of the certainty equivalents associated with the expected returns from basically being in the stock market. And then the cost that an individual draws has to be basically less than essentially these certainty wealth equivalents plus some other benefits that offset these costs, right, associated with peer effects or information sharing. So that the equilibrium participation rate, which is sort of what the paper measures and is on the left-hand side, right, PS in a given area, is then going to be a function G right? G is the distribution function associated with these costs, of basically the ratio, right, of the numerator, which is, alpha, these kind of benefits, like, expected returns. Alpha could also capture how good the financial products are. W, which is some measure of underlying wealth, or you can call it just basic economic development in the area, right? Because if you have more wealth, it's just kind of with the fixed cost, you just have more benefits associated with participating. And then of course there's some B, some peer effects associated. That's going to basically be a fixed point, right? This PS is going to be a fixed point that gets determined. Okay, and theta may be some common region parameter. All right, so what do we think is going on, right? So in the model, right, the financial inclusion channel, you might think could be captured by the parameter alpha, right? This parameter, right? Because if there's bank branches will offer better financial products, right? That would basically, people living in an area with roads that have more bank branches will get better financial products, right? Okay, so you might think that roads could shift up alpha, right? That's what I would, I guess, loosely call the financial inclusion channel. But roads could also lead to more information sharing from people in different areas, right? There's going to be more traffic through the area. There's going to be more of these potential then informational peer spillover effects. Okay. But I would highlight that roads could also just lead to a better economy, right? People are just going to be richer, essentially, right? So they may just also participate just because they're richer, essentially, right? Even if these other parameters don't change. So I think that a good way to frame the paper is really with these kind of three parameters, right? There's like an alpha, there's an alpha effect, there's like this sort of BPS effect, and then there's like this W effect, right? And all of it can be coming from basically these road connections, okay? And I think that's sort of what the paper is kind of highlighting, is that there seems to basically be a bunch of these effects that are happening. But I think to talk about what the particular mechanisms are, it's a little bit complicated, right? Because how do we quantify these mechanisms if this road is like leading to a bunch of stuff that's kind of happening all at the same time, right? Okay. So put another way, suppose I frame the econometric analysis as 2SLS, right? So let's take an example, right? So let's say I'm interested in the financial inclusion channel. So what's my second stage? My second stage says my participation rate in an area is going to be a function of the number of bank branches, right? Okay. So you might think that, the instrument, the first stage instrument is just that, this PMGSY, right, is going to basically shock the number of bank branches, right? Because, when you get roads, you get more bank branches. Okay. And so then the question becomes, well, is that PMGSY also excluded, right? In the second, is it excludable as an independent effect on participation rates through some other channel, right? But of course, the fact that you're seeing multiple channels is kind of telling you that you can't really use PMGSY as an instrument for bank branches if you want to understand the marginal effect of an extra bank branch or financial inclusion on participation rates, right? Okay. So I think that, kind of if you kind of stay within a very reduced form specification, there are these statements that you can make that says that there are these ancillary, seems to be all of these responses, right? A whole host, a vector of responses to this road connection. But it's not so clear actually what the mechanisms are, right? That are kind of driving basically this response, right? So just, I'll kind of make a couple of suggestions. So for instance, I think the paper probably should put front and center as like kind of a straw man, which is, how much overall economic growth and per capita income are you even seeing, right, with these roads? So presumably that's going on, right? Okay. And then you can ask, how big are the effects, right, on these overall city fundamentals, right? Think about that as like the W parameter. And then we can ask, like, look, am I seeing participation rates increasing proportional to the increases in wealth? Or is there a lot of basically excess spatial variance, right? It could be that some places, everybody increases kind of a little bit in wealth, but you're getting massive changes in terms of these participation rates. Right? That would be some evidence of some informational spillover, some informational channel. That's pretty standard in the peer effects literature. And so this is sometimes referred to like as excess spatial variance test, right? So like, if you think that everything is just being driven off of wealth, right? You can kind of document whether improvements in like underlying demographics can proportionally explain changes in these stock market participation rates, right? If they cannot, that would be some evidence actually, right, of a peer effects channel, basically. Okay. And then so my other suggestion is, you could, I think, I don't know enough about the PMGSY and all of the details of these known road networks and everything, but so my comments here are, I think, purely just kind of framing and talking about what I view as kind of useful exercises. I'm not sure they kind of pulled off. So the other way to think about this is like, in terms of the difficulty of dealing with this mechanism thing is think about modeling a system of equations, right? So, one system could be participation depends on financial inclusion, bank branches. But you could also imagine bank branches may actually be a response to stock market participation or interest, right? In other words, like what drives like a bank to open up bank branches could be because lots of people in the area is just like excessively interested in the stock market, right? They may really want to have, a lot of participation. And so basically the banks may respond, the bank branches may respond to that, right? So there's actually then, kind of a system of equations that governs basically the financial inclusion channel versus this sort of like, information channel. And so are bank branches driving stock market participation, or is it really like the participation is driving basically some of these branches to locate there as well? Okay. So as I said, so I think those are my main comments, I think, in terms of underlying kind of methodology and whatnot. And so I will kind of say that the paper as is, right, could also basically be pitched as a cost benefits analysis paper of public goods investments. So I'm sure that the government of India, when they decided to do PMGSY, had a cost of benefits analysis plan. I mean, everyone does, right? To talk about and it would be pretty interesting, I think, if this is available in India, right? Documented in terms of what people viewed as the cost and benefits associated with spending on this infrastructure. And then I think that what the paper is kind of capturing is that, there seems to be some other coincident benefits, like these stock market participation rates, these spillovers. It's not so obvious that the government of India thought that these things would be kind of happening, right? They're probably mostly thinking about these roads as like connection for some jobs and for some, more basic opportunity, right? Were they really thinking about the financial sector when they were basically building these roads, right? I mean, if they weren't, this would kind of fit into kind of this coincidental benefits view that a lot of public goods spending, right? It is kind of like, what do they call it? Like it's the other side of the unintended consequences of like regulation, right? These are the unintended consequences of basically public goods spending, right? And it would be nice, I mean, if it was true, to make kind of the case for that, because the effects do seem fairly big. That the government of India decided to build this road, they didn't even think about the stock market. Suddenly, like the stock market booms, right? And I think the paper kind of pretty cleanly documents these significant coincidental benefits for the financial sector, even though I'm not so sure that the roads were meant for the financial sector. All right, so let me kind of conclude and open up the discussions. So I think it's a pretty valuable and interesting paper on the consequences of railway constructions for household financial outcomes, and really kind of for the financial system as a whole in India. So as I kind of outlined in some of my comments, there's potentially kind of more research to be done, I think, in really understanding the different mechanisms at work in terms of why there's this impact of these roads on the financial sector. All right, I'll stop there. Thanks.
Thanks a lot, Harrison, for your insightful, stimulating comments. I'm expecting a lot of questions from our audience. But before we open up the Q&A session, Pulak, would you like to give some quick responses to Harrison's comments?
Yeah, thanks, Harrison, for the nice comments. Some of the things we are already exploring at this moment. Your comment on the spatial variation is actually pretty interesting. We haven't thought about that, so that's something we can definitely do. These roads were definitely not constructed based on the market in mind. This was more like connecting all the rural roads in India, rural sectors in India, from the nearest to the nearest city. It just happened over time for different things, because especially this was taken, the decision was taken because during monsoon time, particularly for the farmers, it used to be a very bad situation to connect to the market for selling their products. So that's where it got started and then rolled over all over India. But rest of the comments all make sense, and we are doing some of these. Thank you.
Great. I think Bernie and Zhibo both want to ask something. Who would like to go first? Bernie.
Okay, let me go first. Well, first, I want to thank Pulak and also Harrison. This is a very stimulating conversation, and thank you very much. To me, in my mind, like there are two things. One is real causality, and as Pulak said, if this is really random, then we can deal with causality. Then the second thing is to differentiate between the economic effect and the information effect. There is a parallel study in China about the high-speed trains, and the creation of the high-speed trains in one way is like they select, the connected towns are based on real pre-selection. But in any case, what we know is that after the connection, some towns suffered by not having the connection. So there is a effect of after the connection, some towns pull the economic effect, and some towns end up being the loser. I wonder if Pulak can play in the same way and ask the question for towns without getting the connection, do they lose? And if they do lose, what happened to their stock market participation? Playing in this way, I think you may be able to, tease out the purely economic effect, but no information effect. But in any case, I still think that it would be really useful to really articulate the randomness in or the motivation of the building of the highways. And thank you very much.
Thanks, Bernie, for the comment. Yeah, it is random. Random in the sense that it started from state-wise. It has started, and it was first started in the poorest regions and then moved on. So some amount of randomness is there. Now, the other thing, what you said, that to look at those who got it first and the others who didn't get it, then to look at the difference to figure out,
right,
that can be done. And but our sample is from 2004 to 15, and by 15 the entire country got the road. But yeah, we can definitely do that.
I probably has a question that I think it's connected to Harrison's. There's one point that he was making on this banks. So first of all, that I feel like initially you were kind of saying the physical infrastructure help people to get to the stock market. That to me sounds like, clearly that's just a metaphor. There's something deeper going on. And then I realized that it probably is because of the bank account, that you have a, what is it called? There's some
Demat account, yeah.
Demat account. Okay, so because of the the road, it makes the DMA account more accessible, and therefore you get to the stock market. So if I really want a policymaker to think about it, if the goal is to make people participate in stock market, I would not build a road because that's too costly. Let me just give these guys accounts, right? So in that sense, that it seems like to me that's the real thing that we learned. I learned, and then get to the question of maybe you have some endogeneity thing where the road is totally exogenous, but the bank's entry will be endogenous. If you think about it, that's really the key of a DMA account to lead to the participation. So that's my biggest comments when I listen in Garrison's comment and your point. The last part is this information part. You're saying that this is the where that seems like the road really matters. It's like once you build the road, then I can travel there looking at it. I don't have enough knowledge to judge whether this type of things really, really have certain impact. To me, hard to imagine investors just take the train or take the road, drove there, go to the company to have a inspection on site. That's you're gonna tell me that if that's plausible or not.
Okay. So on the bank branch, so we have to understand one thing. So by SEBI regulation, a retail or a commercial bank cannot have at the same time a securities thing. So these two needs to be completely separated with two different entities. They even cannot talk to each other. So in the sense, they cannot share the data of the same person who, let's say, has a savings account, that bank, let's say State Bank of India, and there is State Bank Securities. So State Bank of India retail bank will not have any idea what I'm dealing with my equity trading. They are completely separate. So what the bank branch does is that SEBI allows a lot of other banks. So if let's say State Bank of India has a branch in pin code A after the road construction, then SEBI allows a lot of other banks or brokerage houses to have a demat form in that bank. And all the bank does is that demat form, let's say I have signed it for ICICI Securities or for the standalone brokerage firm, they will just, the dealers brokerage house will send boys to collect those forms at the end of the week, and that's how it works. So bank directly doesn't get into, by SEBI regulation, these are two separated things. On the information channel, the way we are thinking is that this opens up a lot of, so for example, think about farmers. Now they can actually go and trade their products in a far-off market, which may be more beneficial. And in the process, they meet a lot more people. And so they engage in conversations, and there is information flow about the markets going on, which was not possible before. So that was the channel we are trying to nail it down.
Yeah, okay, very good. I noticed, Pulak, your co-author, Meghana, is also
answering,
here.
Yeah.
Right, and he also raised his hand.
I just wanted to pitch in on what Pulak said. First, Harrison, thank you very much for your comments. I think, we definitely are very much on board with this idea of these coincidental effects, right? This wasn't supposed to be a financial inclusion paper. This was really about, what is the effects of roads on stock market participation? And that's why the paper is not set up as an IV or as a two-stage least square. And, that was the motivation behind doing the ID. So yeah, I think we're definitely, I think it adds to the paper to say that it's the coincidental effects of this financial inclusion channel and the information channel. And just to second Pulak's comment on the information channel, I don't think it's about inspecting these particular firms, but it's really about information flows that happen with movement of people. And that's what you see a lot with the construction of these feeder roads, because these are not main highways, but these are really feeder roads to these unconnected villages. So, it's really about, word of mouth information flows that happen between large city metropolitan areas and these remote villages. That's what we're trying to get at. Thanks.
Okay, so let me say a few things about this this very interesting paper. So first of all, I'm also working on road infrastructure investment in China, try to estimate, economic costs and benefits of that. So I totally agree with what Harrison said about the motivation of the paper. I think, one interesting thing that is somehow understated in the paper is financial inclusion is often kind of or the benefit of financial inclusion because of infrastructure improvement is often overlooked in the study. So that's an interesting thing to actually emphasize. And the second thing is I also like a lot what Harrison said about but clearly this is not going to be in the paper, but he was suggesting building up a structural model, for instance, to think about a gravity model and think about how infrastructure investment increases local income, and therefore you can compare the increase in local income with the increase, in local stock market participation, and see if there is a misalignment that will strengthen, I think the motivation of the paper. But as I said, that probably will be a different paper. But what I want to suggest is actually you can explore a network feature of the data. For instance, you show us the effect of connecting to the nearest big city. But what you can do is you can check, the change in the connectivity. For instance, the distance to, say, a better informed city. If you want to emphasize the information channel, if a city becomes less distant to whatever information center is, and then you can explore that. There are a lot richer things to be exploited if you think about the network, right, and distance to the center, or eigenvector centrality, all these kind of centrality measures. And I think the most difficult part is still how to disentangle those mechanisms. Even if you use a network feature, I think it's still going to be hard. For instance, think about one effect recently I realized is once you improve road capacity connecting two cities, and then you see a lot of things going on. For instance, some traders specialize in selling one product from one city to another. Their income will be going up. And then, it's very difficult, I think, using your data set to separate the income effect and the information effect because of this income effect, right? Is there any way in your data set that can help you to disentangle the two things? I think it's
take a shot.
Yeah, go ahead.
So I think you made two very excellent points, right? I mean, on the network effects, that is something that we can definitely look at, right? I think it was part of it was also alluded to by Harrison's last comment. But let me push back a little bit on the income channel. First of all, this is data on individual investor behavior. So we do not have data on income. Okay, so if we had the data on what their overall portfolio was like, overall household wealth was like, it would be easy to sort of disentangle those channels. So in lieu of that, there are a couple of things that we do. First, we look at cross-sectional variation. And what we find is that it's not the most highly developed villages that get the most benefit. It's actually villages at the intermediate level of development. So it doesn't seem to be like a pure sort of this W channel that you saw in the Hong et al. Model that could be driving this entire thing. The second thing that we try to do is use these other alternate surveys, where we look at district level surveys on income, consumption, and saving, and try to tease something out of it. But it's that's sort of second best because it's not at the household level, it's not at the individual investor level, it's more at the district level. But we really data constrain in terms of teasing the incomes channel out very clearly from the information channel. And I should also mention that we look at income shocks through rainfall effects. So, we have tried to address this income question. We have thought long and hard about it. We have tried to address it with the multiple different ways, but, your point is well taken. It's not something that we can, completely nail down very clearly.
I see. So the rainfall shock. So what did you find, using this rainfall shocks?
So the idea was to see if, since many of these places are very much agri-based economies, if there's good rainfall and, the agricultural sector is doing well, incomes rise, do you actually see stock market participation going up in a window around these positive shocks? And we don't see that. So it's not that, your increase in participation is linked to, a good rainfall season, not excessive or not a drought situation. And over this entire period, 13-year period, we don't see evidence of, in support of that. Again, it's indirect, but, it's sort of the best that we could get out with our data.
Why would the participation be so intimately connected with the gain due to rainfall and so on and so forth? Because once you participate, you're staying there. You don't exit.
So Bernie, we were only looking at new investors here, right? So to see whether
Right.
You get a positive income shock, and then do you see new guys coming on into the market? And we don't see that happening as much. So.
I think the one difference is that between I think kind of a rainfall shock and something like a road, of course, is that participation really is a function of a stock variable, which is your wealth, right?
Right.
Because the income is pretty transitory. It's not going to really affect anything, right? Whereas you might think that once the road gets constructed, you're basically having like a stock effect, right? Your PV, the W stands for your kind of the household's PV of their
Right.
And that's it's a little bit also kind of what the bank is kind of doing, right? Your inclusion channel is somewhere between the alpha and but I think kind of from the point of view of narration, there's sort of, I think if you got the government's reports, like the government for sure must have had some projections about what, the impact would be. And I think in some sense, that's a very nice set of baselines for you, right? To kind of capture these coincidental benefits, right? And then I think after that, of course, there's a number of different ways you can talk about what potentially some suggestive mechanisms. But I think the paper currently doesn't kind of quite read like that, right? It doesn't, because it's not really kind of framing like, oh, the government expected this, I find this, right? You know what I mean? Like, there's all this like stuff that the government was, you left out all the government stuff, right? To kind of make the coincident benefits paper. But I think, it's obviously very interesting paper. So I think this is an issue of how you want to position.
I like Harrison's point about the, think about the stock effect, not the flow effect. And in the economic geography literature, we know that after you build a road, there are winners and there are losers. And all those have impact on the stock at the stock level. And so that's why I think that there's some nuance that you can play up and to identify the stock effect that Harrison just emphasized.
All right, very good. If there's no further question, let's conclude this very interesting, stimulating webinar by thanking all the participants. And I would like to do a little bit advertisement for the next event. If I'm right, then I will be the next speaker talking about COVID policies and its economic impact on the Chinese economy. So if you're interested in that, come here. I don't know where. Actually,
it's on August 18th, and it's a very, very important, timely topic because China is still talking about a lockdown. And be careful after you have spoken. You may be careful about whether to enter into Shenzhen.
All right. Okay. Thanks a lot, everyone.
Thanks so much.
Thank you.
Thank you, everyone.